And we are live with Michael Douville from sunny Scottsdale, Arizona. Michael, how are you?
I'm great, Paul. How about you?
I'm good.
You
You
look
know, we
like
were
you're
talking.
enjoying yourself. You look healthy and wealthy.
Yes, it's been a good year. Last year was good. This year's good. So it's going to be interesting to see how the year plays out, how the rates go, how um, how the economy is going to look.
It's going to be an amazing year. I'm really looking forward to it. It's going to be a lot of data going on, a lot of stuff going on in the economy. I'll tell you that. It's amazing. It's just been really fun to watch.
Okay, well, let's jump into that. This first chart here is median sales price of homes sold in the U.S. This is going back to the 1960s that this chart has been that they've been collecting data, and what it really shows is that at certain periods that we've had some market corrections. This is the big recession that we had, and then in a minute I'll let you talk to this section up here, Michael. But what it really shows is that even during all this time, this chart's over 60 years old now, that there really has never been a sustained deep depression regarding housing and housing prices. Yeah, things have gone up and down. We've had some corrections. And, the biggest one in 2007 to 10, it took us, I think, 6 years to get out of that. And, but we still come out of it and markets still appreciate, and on we go. Any thoughts on that?
Well, I love the chart. First off, it's FRED, which is Federal Reserve Electronic Data. It's so authoritative, and they do such a wonderful job getting the data and collating it, and it's very easy to get into their system. So I would highly recommend anyone to go do that. But the two that you have circled, those are the completion of the cycles. You can use that if you were to build a model. And of course, everyone is concerned about the great financial crisis. One has to remember that when you look at these charts, you can easily see that bubbles are very, very rare. It's very, very unusual to get a bubble. I mean, people are always saying, "Oh, we're going to go into a bubble." Boy, a bubble is just something that just doesn't happen very, very often. And there's always signposts along the way. There's tell. The other thing you look at is that when real estate kind of completes and start getting to the end of its cycle and starts to complete the cycle, it always has tells. We always know where we are, but it generally precedes a major recession. So until real estate starts to roll over and it starts to really finish its cycle, I don't think there's much of a concern about having a major recession. I don't see that. I know there's a lot of concern at the moment because we're raising interest rates. The COVID one was kind of like a government made recession. It was deep. It was certainly pervasive. It went all across all, and it was really really a terrible recession. But it was short, and that was more of a government response. Made a recession in 2020. I know we talked to Charles Denner right before that. He saw it on his charts, but you don't really see too much on this, and housing just did not react to it. So again, it shows that housing is counter cyclical oftentimes to the stock market because this is housing. People often confuse the stock market with the economy. So in a perfect world, the stock market would be a reflection of the economy, but oftentimes it's very, very liquid, and we've had a lot of liquidity that's been put into these marketplaces, and it really has propelled the stock market higher.
Right.
So
And one of
this asset class just keeps
the people
going.
that follow us, where you talk about your model and uh, how it predicts some of the things. And this upper bubble here, you were talking about how we predicted this double correction that was going on here. Do you want to talk to that?
Yes, yeah, that's a perfect illustration. So when you look at this over a really, really long-term time frame, so it was what 60 years, I think this is 50 or 60 years. You can see three distinct completions. The top circle that you circled was the mid-cycle correction, and that just shows as clear as a bell. Our model showed two corrections. The first one, of course, we nailed absolutely to the month, and that was March of 2018. We knew that was going to be a fairly long correction that would go for 5 or 6 quarters, and would eventually be a really good buying opportunity. A lot of our investors bought then because we just thought that was just a terrific time because we knew we were going to pop beyond that. And then we got the second correction, and that was right at December 2019. We started to correct again, but that was very, very short lived. But they're very distinct. You can see that on there, and those are mid-cycle corrections. We're good from those cycles for another 7 years. So according to my model. So
Right.
this is 2022. We have another. We've got a few years yet before we start thinking that we're going to have problems. There's going to be a lot of stuff goes in between. They don't go in a straight line. They kind of squiggle, but they continue going up. And I think you're going to see prices go considerably higher from here. And as we've been saying in our videos, I think everyone is going to be very surprised how high we go. And our model has just been very, very accurate. Doesn't mean it's going to stay accurate, but it has been very, very accurate. And it just keeps going. Yep.
Okay, so this here is housing starts, and this is the build cycle right here. Right here, prior to the big crash of 2007, and then everything falls right off, and there's no more building permits being issued. And you can see that our building cycle from the crash of starting in 2010, let's say, to now, we have still fallen behind, and we haven't been building all that much compared to other times where our building permits, there was a lot of them on the market and a lot of stuff ready to come to the market. Any thoughts on that?
Well, builders build. This is just what they do. And of course, they really took a drubbing in 2006, 7, and 8 when they overbuilt because they were coming to the end of the completion of the cycle. They just kept going and going. I mean, I know here in Phoenix, we just built and built and built, and then they got burnt, and the lenders took the funding away. And you can see that the permits just fell right off a cliff. But here's the thing: our population growth did not fall off a cliff; it just continued. So even though we weren't building, we still had the shortages, and we still had the need for those housing units, but they just weren't being built. So that kind of got a pent-up demand for later on, and that's what we're paying for right now. Because at one time we were like 10, 11 million units short, and you can see that some of the housing permits is starting to accelerate again, but we're still short around the country. I think 4 or 5 million units. And of course, here's the other thing that's really compounding this is that we have housing in the wrong spots in the country. So Florida, Texas, and Arizona, a little bit in South Carolina is doing pretty well. But we have a big demographic shift. You've got a lot of the baby boomers of my age, of course. We've got 10,000 baby boomers a day for the last 5 or 6 or 7 years that have been retiring. That has accelerated. I think it's up around 12 or 13,000 people a day, baby boomers a day, because it's been, business has been kind of tough. And, you kind of get to the end of your career and say, well, enough is enough. And they've been retiring. And of course, they've been moving. So you've got this demographic shift. And Arizona, Florida, and Texas is where people are going. There's just not enough housing. Here in Phoenix, you and I have chatted. We have a housing shortage, for rentals and people wanting to come here and start their families and get their businesses going. You got a lot of IT going here. We just don't have the housing to do that. So not only have we had a shortage, but now we've got this huge influx of population. And of course, you see that in Florida, Texas, and Arizona. So if you're building like mad in Fargo, North Dakota, I don't think that really helps you here in Phoenix, Arizona. So
right. So the previous chart was the national chart, And this is a local chart, and it supports everything that you were just saying, whereby, you know, we have not been building very many homes, since basically 2009. Things have really slowed down. So there is a housing shortage definitely here in the greater Phoenix market. And it may not be everywhere across the great nation that we have, but here in Arizona, it's definitely an issue for us. And I
Well, we
see,
were the postcard. We were the poster child for bad business here. Over exuberance.
well, and are we in a similar kind of scenario? Because right now we're the epicenter of what's going on. We have so much money here in the valley, and there's so much cash here, so many cash buyers, big REITs coming into the market, and they're just buying up everything. And you and I, over this last couple of weeks, have had our own transactions bought by these REITs, and they're typically over asking, all cash, quick close. What's your reflection on that?
Well, I know a lot of people want to draw comparisons because it was like such a stain on our memory, this great financial crisis. We're so different from what it was. We just don't have that that inventory build. We're nowhere near that. Builders are being very, very constrained on what they're bringing to marketplace, which is keeping the inventory very, very low. We don't have an inventory buildup at all, and we have a huge influx of people coming in. Now, and also, if you recall back in 2005, everybody was leveraging as low as you could possibly get down. We had people who were, the ninja loans, no income, no job, and they were getting loans. We just don't see that. We see a huge, like you were saying, huge amount of cash that's coming in here. So even if we have some kind of, these are income investors, they're not capital gains. During the great financial crisis, just leading up to it during the bubble, people were not using as they were buying a property and they were flipping it among their group each time, adding $50,000 to the sale and just skimming off money from lenders. Just don't see that. We're seeing a huge amount of cash. And of course, we're seeing in one of my big indicators is when you see rent, it's coinciding with the rise in price. So when you see a rise in rent and rise in price going up together, they go up in the same parallel, and that delta in between remains the same. That's telling us we have a healthy market, and that remains to be what we see. Now, we're seeing rentals go up, but we're also seeing prices go up. So they justify the price. I think we have a very healthy market. Now that may change, but I don't see that any time in the next foreseeable future. We can look out 6 months to a year. I don't see that at this juncture. I think we're fine.
Yeah, you're absolutely correct. Because now we have Dodd-Frank, which had a huge impact on lending practices, and referencing back to 2007, very loose credit standards to get a mortgage, and a lot of speculative building and buying during that time. And one of the things that are actually helping the builders right now and helping the prices stay higher is the supply chain constraints. Because if they could get everything that they wanted right now and build as fast as they could build, we would be flooded with the market with a lot of properties that are new to the market. So let's get into our next point. I know you've got a lot to say about this, and this is red hot inflation, and this ties back in to what you were just talking about: housing prices and rents continuing to go up.
Well, it's all across the news. Did you have a chart coming up, Paul?
There is a chart. Yep.
I think
this chart is also right here.
Look at that.
This is the rents chart and the CPI chart.
I don't see that on mine.
You don't see the chart at all?
I don't, no.
There. Oh, I'm sorry. I got it on the wrong
There
rookie.
it is. Yeah, oh yeah, this is just that is so illustrative of what's going on, and you can see just by looking at this chart. Now, this is the urban consumers. This is all across the United States for rent. People are renting their homes, and you can see there has been an absolute increase. It's just been going up on a nice incline, an easy increase all across the country. We have no decline on that, and there's no great financial crisis. There's no problems when you get into a recession. The rent just continues going on. So oftentimes we as investors forget we have really our asset does two things for us. It grows in value, but for 30 years, most of the time it doesn't matter because we're not going to sell these properties, particularly when we're using for rent or for retirement for ourselves. So when I counsel my investors, we're really income investors. We're looking for what does this asset deliver to us and what does it generate for us to use for income. And that chart absolutely positively lets you know that you get a consistently and growing rental income over the years, even through some really, really rocky roads. Now, I was here in 2007 and 8 and 9. Prices were pretty volatile, but the rents were just steady as a rock and they just kept rising. And we did pretty doggone well. I know my wife and I, we went to Australia in 2008 with our kids for the summer, like we always did. We were just not impacted at all because the rents just kept coming in, and that chart shows that really, really well. Now, what that means for like you and I, we were talking about this before. When you get baby boomers that are looking to retire, we sometimes are short-sighted because we probably going to live to 85 or 90, 95 years old, and we need an asset like that that's going to deliver income and it's going to increase for us and maintain our purchasing power. And that is an absolutely beautiful chart. That just really, really, just a gorgeous chart. Again, a Fred
This
chart for you. Nice.
in this circle I drew here, you can see right there, you know, rents never really went down. They flattened out, but they never really went down. And then boom, after that, everything started increasing again like mad.
Yeah,
So let's move
continue
on
the
to the
rise,
next.
continue the
Right.
increase. Yeah, it has been an absolutely outstanding asset for the last 40 or 50 years. And this is the consumer price index. And can you go back to that? Now look at this and look at that. The two look very, very comparable, and you can see that your rent is keeping uh, tabs right along with the consumer price index. So and that is such a wonderful thing to have in your portfolio, is something that's going to maintain its value, maintain its income for you, and protect you from inflation, because that's exactly what that is doing. It's showing the fact that you as really any investor, particularly important for baby boomers, because once you come out of that labor force, we don't, the income we have becomes very, very important to us. But that is showing you that you're inflation protected. That is just an absolutely wonderful chart. That's a very good choice, Paul. That was great. And again, it's a Fred chart, so just doesn't get more authoritative than that. That's an absolutely one, and that is so terribly, terribly important today when we're talking 7.5% inflation, and it's not over
Right.
with yet. We don't see this thing slowing down. It just continues. So I don't know how many people that I counsel with that are 72 years old now. They retired at 62, and now they're struggling. They thought when they were 62 years old, they had $50,000-$60,000 a year in income coming in. They thought like they were on top of the world, and now that income is buying them less. We forget that our dollar gets eroded, even with benign inflation. We get round out. I mean, after 20 years, your dollar has lost significantly 20, 30, 40% of purchasing power. So if you had 60 or 65,000 10 years ago, you probably have an equivalent of maybe 35,
Right.
45,000. Oh yeah, there's
Right.
your work chart. Sure, of course. Yeah.
Now, this chart comes to us from our friends over at the Cromford Report,
Mhm.
and it supports everything that we're talking about, how rents are going to continue to go up. And you can see how dramatic it has been from 2008, up to present day. We get some little dips usually in the first quarter of the year, but typically it continues to grow up. And then you get into the affordability of it. And, people now, they have to be making somewhere around $94,000 a year just to rent. It's a pretty staggering number when you think of it. And go ahead.
Well, you bring up a good point, Paul, is that the average wage earners has really had an increase in their salary. They've done very, very well. It's a great time for you to be a worker. It's a great time to be a small businessman or someone that's doing side work. People that are in the trades are just doing really, really well. They're commanding higher wages. They're commanding more jobs. They're getting more business, but they're giving it back. So unless you are one of the owners and you can get onto the train, you're exactly correct. They're giving it back on inflation, and they're giving it back on their rent. So you make an extra $300 or $400 a month, and your rent goes up $300 or $400. So you're kind of not getting anywhere. It's a really, really good point. So the point, and I think what you're making is that it's really, really important that people get a house of their own as quickly as they possibly can. So far, I see absolutely no indication that houses are going to go backwards, that we're going to have any kind of a decline, that we're going to have any kind of a bubble burst. I don't see a completion of a cycle. It looks to me like we have inflation and we have prices heading up. And if you don't get on it, yes, you're going to make an extra $400 or $500 a month, but your rent is going to go up an extra $400 or $500, wiping it all out. It's just a terrible scenario unless you buy a house, right?
Right. So let's move on to our last slide, and then we'll wrap things up. So this is also brought to us from the Cromford Report. And, studying trends and following all of this through, we're still going to see prices increase. We're still going to see prices increase over the next foreseeable future. It's always going to be hard to predict what that is going to be, but all indicators tell us that prices are still going to go up.
Well, I think prices are going to go up nationally, everywhere. A lot of that's going to do with the fact that we have inflation. So we were running at 7.5% inflation. I don't know if we're going to get double digit. I started in the early 70s, and from 1975 on, we had 6 or 7 years of double-digit housing growth from the inflationary 70s, and really drove prices up substantially. We could get something like that. We see nothing in any of our data that is indicating any kind of a slowdown. So, and particularly in the hot markets. Now, if you're an investor, if you're going to get a professional management, then you can really buy in any market that you want to. And I can't imagine why you wouldn't want to buy in a hot market. Why would you want to get into the mega trends that you have of Florida, Texas, and Arizona that have trends that are going to last probably for decades? So if you can buy a property in Florida or Texas or Phoenix, Arizona, well, I think you're going to get not only growth of principal and growth of income, but you're going to have growth of value assets. And these properties, just like what you're saying, we see absolutely no slowdown, really. I think we're going to see prices go a lot higher than people think they're going to. I think they're going to be absolutely amazed at how high prices go. So
Yeah.
I love your charts, Paul. They look great.
I think that's a tremendous insight you brought there, Michael. And I'm just going to play this video real quick, and we'll wrap it up after that. So just a little self-promotion here for you, Michael. I know you're author of two great books, and they're both available on Amazon, I believe, right?
Yes, Amazon, the creating how to create real estate money machine is worldwide. It's absolutely everywhere. But the workbook is we've kept it on Amazon because they're just so wonderful at getting these. They're just an amazing company.
Okay, well, that's great, Michael. Well, thanks for joining in, and thanks for all your comments and feedback and insight on that. I hope people get some real value out of today's session.
Well, thanks, Paul, for the chat today. And if I can give any kind of a wrap up from what I see and from what the data that we're looking at, and we're getting very, very good data from the Federal Reserve Electronic Data System. It doesn't take a lot of interpretation on this. It looks to me like inflation, demographics are a powerful combination going to drive housing prices much, much higher. Interest rates are coming up a little bit. So it's to everyone's advantage to go out and buy a property as soon as they possibly can. If you're a grandparent, help your grandkids buy one. If you're a parent, help your kids buy a place. And if your kids and your parents don't own one, help them buy a house. Everybody should own a piece of real estate. Now, we're not telling you to sell all your stock and just buy real estate, but real estate is a very, very compelling investment. It's right in its great trends, and it should do very, very well for everybody. So Paul, that's where I'm going to leave it for today. If they can reach us, they can reach me at michael@michaeldouville.com. I'm more than happy to talk to anybody. And thanks for having me today. Appreciate it.
Yeah, thanks again, Michael. We'll talk soon.
All right. See you. Bye-bye now.